Hello there. My name is Edison. And today, I will show you how to pay off your 30-year home mortgage in just 5 to 7 years. If this is something that sounds interesting to you, then grab your popcorn and let's begin. I have taught this method to many of my family members and close friends. And today they are grateful and thankful that they were able to apply this method. So, stick around and I promise you that this video will change your life. Literally. By the way, I have also applied this method to my own mortgage. Or should I say, my already paid off 30-year mortgage, which I paid off in full in a total of 6 years. Don't believe me? Well, let me start by giving you a hint. It has to do with how the interest rate is calculated on your existing loan, also known as a mortgage. Come with me into the next room. I will show you on the whiteboard so that you can follow along. I hope you don't mind, I changed to look a little more business casual for you. This is what we will be covering in today's video. What is a mortgage? How is compound interest different from simple interest? And finally, how to pay off your mortgage in 5 to 7 years. So, what is a mortgage? In simple terms, a mortgage is an agreement between you and a lender, and gives the lender the right to take your property, if you fail to repay the money you've borrowed plus interest. No one wants to lose their home. For this reason I have created this video. Next, you will learn the difference between compound interest and simple interest. Have you ever heard of compound interest and simple interest? You will learn exactly how compound interest is calculated versus simple interest. Don't be scared of the numbers. The concept is actually really simple. Simple interest is calculated on the principal, or original amount of a loan. Compound interest is calculated on the principal amount and also on the accumulated interest of previous periods, and can thus be regarded as interest on interest. Let's begin with simple interest. This is the formula for simple interest. Principal times interest times the term of the loan. That's it, it's simple. Get it? Yeah, I am not good at jokes. Therefore, if you have a $10,000 loan at 5% interest for a term loan of 3 years, then your total loan interest at the end of 3 years will be $1,500. Now let's take a look at compound interest. Compound interest is how the interest on your mortgage is calculated. Which is why we suggest you turn it into simple interest to pay much less. And pay off your entire mortgage in a few short years. But we will get into that shortly. The formula for calculating compound interest in a year is compound interest equals total amount of principal and interest in future. This means that you are paying interest on the interest of the loan. And this continues for the entire 30-year length of the term. So, you end up paying much more in interest and also takes you longer to pay it. So, let's look at the same numbers we use to calculate simple interest and look at an example under compound interest. If you have a $10,000 loan at 5% interest for a loan term of 3 years, then you end up paying a total in interest on $1,576.25. That is $76.25 more than what you paid under the simple interest example. And now for the moment you have been waiting for. So how exactly does this method work? There are a few requirements. The first and the most important one is that you must have discipline. The second is that you must make more money than you spend. And third, you have to convert your loan from compound interest to simple interest. The reason you must be, or learn how to be disciplined, is because once you learn this method, you will be able to apply it to anything, not just your mortgage, but also any car loans and even student loans. The second requirement is that you make more money than you spend, and this is simply because you will be converting chunks of your compound interest loan into simple interest loan and you will need to pay this off. This is why rule number 1 is to have discipline, and the third requirement is to convert your compound loan into a simple loan so that you pay less in interest, and therefore get to pay off your mortgage in a few years. The average person in the United States makes $56,000 a year. We are going to round that off to $60,000 for easier math, which will come out to $5,000 a month in net household income. The average price of a home in the United States is $200,000. We will use this price for our loan illustration. It will be a 30-year fixed mortgage at a 6% rate. This makes the monthly payment $1,200. The next most common expense is minimum payment on a credit card. So, we are going to take a look at a line of credit. The credit limit on this line of credit is $15,000. We will say this is a Visa credit card for illustration. The current existing balance is $12,000. The current APR is 21%. And the minimum payment is $600. So far, we have come up with two common monthly expenses: the $1,200 mortgage expense and the $600 minimum credit card expense. So, at the beginning of the month we had $5,000 coming in. We also had $1,200 in mortgage expense, $600 in minimum credit card expense, perhaps car payment of $600, and finally living expenses of $1,200. After all expenses, you are left with $1,400, which you will most likely put into a savings account. Unfortunately, this is the model that 95% of Americans live by. So, how do you start to manage your money like the other 5% do to manage your finances? Well, for that we need to look at our previous mortgage and the line of credit example. The first thing that should stand out to you is that the mortgage had a 6% rate, and the line of credit, or credit card, has a 21% rate. Therefore, if I were to ask you which rate you would prefer, you would logically take the 6% rate. But before you do that, just remember that the mortgage at 6% is a compound interest calculation, and the line of credit at 21% is a simple interest calculation. Just remember that we are looking at two different units of measure. Simple interest is interest on principal only, and compound interest is interest on principal and interest on interest. So, you end up paying more for the same loan amount. Also, your mortgage is one-dimensional and your credit card is two-dimensional. This means that once you make a payment to your mortgage, you cannot take that money out and reuse it. But with your credit card being two-dimensional, once you pay the credit card, you can reuse it to go to the movies or buy groceries. In addition, your mortgage is amortized. What this means is that the bank knows that you have 30 years to pay back the loan. Therefore, when you make the monthly payments, the biggest portion goes toward the interest, and very little goes towards paying down your loan or principal. Remember that in our mortgage example, our payment was $1,200. Well, $950 goes towards interest and only $250 goes towards our principal. Let's quickly look at an amortization schedule. As you see, we have the monthly payments on the left vertical line, and the timeline on the bottom horizontal line, in years. As you can see, our monthly payments are $1,200. $950 is going towards paying down your interest and $250 is going towards paying down your principal. So this is what the chart looks like. As you are making your monthly payments every single month, the interest pay down is less and gradually the principal pay down goes up. These two lines, interest and principal, intersect at around the 17-year mark. This means that for the past 17 years you have been paying more in interest than your actual principal paydown. Most people throughout their entire life are unable to pay off their mortgage. And the main reason for that is what happens at around the 4-year mark. Let's take a look. 4 years equals 48 months. Since our payments are $1,200 every single month, I'm going to multiply that by 48 months. And that gives us a total of $57,600. That is going to represent total paydown. Now, $950 went towards interest paydown. Therefore, that equals $45,600. And $250 went towards principal paydown. That equals $12,000. Alright, so I really want you to take a look at this and see that in 4 years of making consistent payments of $1,200 a month to your home loan, you have paid a total of $57,600. $950 went towards interest. So, out of the total paydown of $57,600, an alarming $45,600 was kept by the bank in interest. And only $12,000 went towards the loan or principal paydown. So now, what is the main reason that most people don't end up paying off their mortgage? Well, right around 4 years into the loan, the bank will call up the homeowner and they will entice you to refinance to a lower interest rate, so that your monthly payments are lower. What most people don't realize is that when you refinance your mortgage, it resets the amortization schedule. In other words, from your new lower payments, as they call it, the bank will start keeping most of it in interest. So while you think you are saving money, because your payments are lower, in reality you end up paying a lot more in interest in the long run. This is because, as your mortgage progresses, you pay less and less in interest and more of your payments go towards the loan paydown. Remember this amortization schedule? As you can see, the longer you pay your mortgage, the more of your monthly payments go to the principal of the loan, and the less of your payments go to the interest of the loan. But, when you refinance, you reset this and restart at the beginning. Therefore, you begin paying more in interest again. Okay, now that you have this mortgage, what do you do to pay it off faster and save a lot of money in interest? Get excited, because this is where I get into the strategy of how to pay your mortgage off faster. The strategy that I am about to teach you requires that you bypass the system of checking and savings account completely. And, take everything that you earn for the entire month and year and apply it towards your line of credit. So, we are going to move our entire income towards our line of credit now. It might sound crazy, but I am going to show how to continue paying your bills and pay more towards your mortgage by using this method. Before I go on, I just want to ask you, why do you save money? Well, most of us have been taught from a young age to save money because it is important, and it is. But wealthy people know that you never want to let your money just sit in a savings account. So, what they do instead is that they invest their money. Here's the thing. We save money, in case we have an emergency. But a savings account only pays you 1% or perhaps a fraction of a percent. But if you needed to borrow money from the bank, they will lend it to you at a much higher rate. Perhaps 3, 5 or 10%. Who knows? One last thing. Let's say you have a savings account with a balance of $10,000, and you are earning 1% on it. But then you need to buy a car worth $10,000. The bank will say, we will lend you the $10,000 at a 5% rate. So they are lending out your own money and making lots of money on it. So, now that we are no longer letting the bank control our money, and we are putting it into our line of credit, this is what it is going to do. Remember that our line of credit has a $15,000 limit, and we currently have a balance of $12,000. Since we are taking our entire monthly income and putting it towards our line of credit, you can see the balance on the left and the timeline on the bottom. Therefore, we have monthly increments. If you follow this strategy, then you will take your entire monthly income, which in our example is $5,000, and deposit the entire amount into our line of credit. This will automatically bring down the balance from $12,000 to $7,000. And don't forget, remember that we had a $600 a month payment to this credit card? Well, you no longer have to worry about that expense since you're automatically depositing your entire paycheck to this line of credit, and that takes care of the payment. And that will create a $600 positive cash flow. And since we are no longer saving our money, remember the $1,400 left over which went to a savings account? Well, the $600 credit card expense and the $1,400 savings creates a total of $2,000 cash flow. So now if we add up the expenses, it equals $3,000. Because we still have to pay our home loan mortgage payment of $1,200, we still have our car payment of $600, and we still have our living expenses of $1,200. To pay the monthly expenses of $3,000, we are going to use our line of credit. Therefore, that same month our line of credit will go up by $3,000. So this is our first month. Next month we are going to use the exact same strategy. So, that bumps us down from $10,000 to $5,000. And of course, we have the $3,000 monthly expenses. So our balance goes up to $8,000 by the end of month 2. Third month, January. We are going to repeat it again. Deposit all our income of $5,000 into our line of credit and pay our expenses of $3,000 from the same credit card. So, our balance goes down from $8,000 to $3,000. Then, we pay our expenses of $3,000 and our balance on the line of credit goes up to $6,000 by end of January, which is month 3. On month 4, 5 and 6, you keep applying the same strategy. As you can see, by the end of month 6, you would have paid the entire balance of $12,000 in 6 short months. So, what do we do now that this credit card or line of credit has a zero balance? You cannot take your income of $5,000 on month 7 and apply towards a line of credit that now has a zero balance. So what do? Well, this is where you have to create more debt. And as you can see, not all debt is bad, if you know what you're doing. There is actually good debt. So what do? Well, you go to the bank and you tell them that you want to apply $12,000 from your line of credit towards the principal balance of your mortgage, your home loan. It is very important that the person at the bank understands that this payment will be towards your principal paydown and not regular payments. Because if they process this towards regular payments, then it's just going to take a chunk of it and apply it towards interest. And that's not going to work, so it is important that they understand that this payment is towards principal paydown. As soon as you do this, your line of credit will logically go up to a balance of $12,000. Now, if you keep applying the strategy I just showed you, then you will have the new $12,000 balance paid again in 6 months. The most important thing to notice is that you are able to pay down $12,000 every 6 months without earning any more money. Where if you pay it the regular way, it would have taken you 4 years, and in the process the bank would have made 4 times that amount from you in interest. Remember the analysis we did on the 4 years or 48-month regular payments? This allows you to pay $12,000 towards the principal of your home every 6 months, as opposed to 4 years, and saves a homeowner $45,600 in interest. So, the strategy is that every 6 months, you keep going back to the bank and applying $12,000, because you are paying it down in 6 months. And you keep going through this process again and again, until you have paid down your entire mortgage loan balance. And that's how you pay it off in about 5 to 7 years. Now, what about emergencies? Well, we have all this cushion over here since we are no longer putting it into savings. One more important thing. The bank is most likely going to raise your $15,000 credit limit on your line of credit. And this is because you are using $12,000 and paying it down rather quickly. Another thing that is going to happen is that your credit score is going to go up. I guess the only question I have for you is, would you rather pay a 6% rate or a 21% rate? I hope you know the answer to this question by now. Please feel free to watch this video as many times as you need to understand this easy strategy. And please like this video, subscribe, and share with anyone you think may benefit from this strategy. Thank you, and I will see you on the next video.